I want to bring in Doug King, RCMA Group Chairman. RCMA is a diversified group of businesses spanning supply chain, energy, and consumer goods and services. Doug, good to talk. Al was talking about the fact that at best, his reporting is showing 50 vessels could be cleared a day through the canal. What do you think?
I mean, obviously supply chain is back. When I spoke last on the program with you, we talked about supply chain problems out of South America and delays on freight there. Here we've had the very big, great pictures of the huge vessel blocking the Suez Canal. So clearly, the markets have responded, I would say, skittishly. I mean, oil, we're in the Middle East. I've been shocked by the volatility last week on oil markets because, frankly, oil really isn't the big issue here. We can move oil up pipelines alongside the canal. It's a very limited amount of crude oil that actually goes through the Suez Canal anyway, maybe 4 or 5% of actually seaborne trade. So, I think there's been an overreaction because we're in the Middle East and what have you. But the bigger picture is the supply chains of the container-based products particularly are under huge stress, whether it be the West Coast of the US, whether it be Suez, whether it be the Panama Canal. And we know that that's likely to continue. And as I've said before, it's going to be inherently inflationary, I think, to the supply chain structure of commodities as we look forward through 2021.
What are the lessons learned from this, Doug? Are these ships getting too big? Do we need smaller ones? Reducing the risk. The risk is now absolutely enormous as we pile more and more onto single vessels. How long is it going to take before the supply side, in terms of the number of containers available, starts to ease, the number of ships starts to ease? Can you just kind of walk me through the more medium-term implication?
Yeah, I think it's a very good question. I mean, when you're talking dry commodities such as soybeans or cargoes or iron ore, those types of commodities, they're shipped on Cape-sized vessels. They're called Capes because they have to go around the Cape of Good Hope and Cape Horn. Now, you look at the size of the vessel going through the Suez Canal there, and frankly, it just about fits. So, why isn't that going around the Capes? I don't know. Maybe I'll have to rethink the sizing. I definitely believe that there will be a lot more time in transit for those types of vessels through the Suez Canal. Nobody wants this to happen again, which may well delay the actual speed of actually transiting the canal. And frankly, it's just a wake-up call for people to realize what sort of size containers are being moved globally to meet the demand from people at home clicking, wanting white goods, and all the other areas that we're starting to see add to the inflationary pressures around the world.
On the flip side, though, I was reading a lot this weekend about how, for the LNG tankers in particular, if they go around, they won't have to pay tolls, so they can handle higher freight costs and their offsets. What do you think about that?
I think it's absolutely true. Obviously, you pay a tariff to go through the Suez Canal, but you get there quicker. If you go around the Capes, you burn more fuel, you get there slower. So, it's interesting that some of the markets, such as diesel fuel in Europe, is in what we call a contango, i.e. it's more expensive in the future. So you're actually better off going around the Cape because your product gets worth more the later it arrives. So all these considerations will be there for everybody to review. But I think, frankly, the size of that vessel going through the Suez has just woken everybody up to the fact that, bad weather, maybe they'll close it for those types of vessels, which will again slow down the transit of those types of vessels through into Europe and out of Europe towards Asia.
In terms of other facilities as well, this has also made everybody realize that the ports in particular are woefully at the moment undersized. You look at the number of vessels that are sitting off California right now waiting to unload. That's another problem. We're going to get an infrastructure bill later on this week from the President of the United States. How much do we need to spend getting this sorted? How big a problem have we at the moment in terms of underinvestment, do you think?
Yeah, I think it's big. I think it's a very, very good point you make. And I think the thing that's really exacerbating it is the human capital side of it too. People just, if they're not well, or they can't get there, or people are taking precautions, it just absolutely slows it down hugely. Not to mention, as you say, the infrastructure side of it. So, when you put those all together, you just can't run global supply chains that are so long without working capital deployed in inventory at your site. You have to have more money tied up in product that you need to produce your finished goods. And clearly that will be inflationary. And the world is just starting to realize that. And it just is a new sort of thing, because we're so used to efficient action and just, I don't need to tie up my money that way. So I think that's a major change.
So Doug, to that point, if we stay in the commodity world for a second, what commodity or what product is going to be the easiest to reallocate in terms of getting your supply closer, et cetera? And what's the hardest?
I think it's not going to be quite as easy as that. Soybeans are grown in South America and they go to China.
Yeah.
It's mined in Australia and Brazil, and it goes to China. Oil, we know where it's produced and where it flows. What you need to do if you're using these products is you need to have higher inventory at your destination, which means it's a demand for higher inventory, not because you're using it, just because you have that comfort. And what that means is suddenly to the commodity markets, there's additional supply, additional demand that comes in that isn't real, but is seen as real because it's restocking and it affects market prices, which is why we remain bullish overall commodity prices over the next cycle of 1-2 years. Oil is one thing everybody focuses on oil. Oil's got problems because demand is still sluggish. It's fine on a bit of gasoline, but diesel and jet fuel is really, really lingering as Europe and other places who use mainly those products are just not getting it going. But oil will gradually get there, and we believe with the OPEC meeting coming up, the Saudi will be particularly hawkish still. He'll try and keep it tight. He wants higher prices. And so we'll gradually grind our way probably higher. But other commodities we see as far more bullish, and I've spoken about the softs and the commodities and agricultural products in previous times on the show.